This is Robert Kraft, and I'm your host on the Planet MicroCap podcast. Just wanted to remind everybody that you can go and follow the podcast on my Twitter account. It's at Bobby K Kraft, BobbyKKRAFT, and you can listen to our podcast on anywhere that you get podcasts out there. And one more quick thing I want to let everybody know: we are going to be hosting another virtual investor conference coming up August 3rd through the 6th, 2020. Go to our website, conference.snn.network, and you'll get all the information on that. We're going to have a number of companies, keynotes, panels, the works, one-on-ones. And yeah, I invite everybody here who's listening to go and register and come on to our and join us at the event. So without further ado, I'd like to introduce my guest today. It is Lawrence Hamtil. He is the investment advisor at Fortune Financial Advisors. I've been following Lawrence for a while now, and we're gonna really get into it today. You know, from everything from the inside jokes to really digging in on his investment philosophy and strategy. So with that, Lawrence, thank you for joining me today. How you doing?
I'm doing well, Robert. Thanks for having me.
It's great to have you on. So, look, I put it. We're recording this on Thursday. What's today? Thursday, June 18th. I put out a tweet yesterday asking the Twitterverse if they had any questions for you that really we should dive in. And here I thought, okay, these are going to be like really, we're going to be talking about investment philosophy. And really, I wasn't disappointed in some of the questions. So I figured we'd start off by giving the people what they want. Let's answer the questions. We're going one by one here. So Lawrence, you game?
Yeah, sure. Let's do it.
All right. So the first question came in from Ian Castle. By the way, I'm going to call up everybody who actually gave these questions in. So thank you for sending them in. Ian writes, what is your favorite brand of Marlboros while squatting? Like 27s or lights? I mean, what are we talking about?
I'd have to go with the Reds. And full disclosure, I've never actually been a smoker, but, that would be my choice just for style points.
For style, I mean, if we want to go like full hipster, we go 27s though. Like we can't just.
I think that's fair, but the hipsters really squat,
I've
never seen it.
I mean, there's a lot of chicken legs out there, I guess. It's just mostly upper body. All right,
it might be a unicorn type thing there,
All right, so our next question is from Dean at Petty_Cash. What up, Dean? And he's also a fellow lifter as well. So I think you guys should do a podcast just talking about that.
Okay.
He writes, how are lifting and investing similar? And this is the most important part is, do women prefer guys with abs or big glutes, and why?
Well, if you ask my wife, she would say that, women really probably prefer men with bigger wallets than, any sort of, anatomical advantage as far as muscles go. But, in all seriousness, I think there is a little bit of an overlap there with weightlifting and investing. They both require a plan. They require feedback, from peers. They require a lot of discipline, and it's a lot of time under tension. It's compounding slowly over time. You don't just keep adding 5 pounds to the bar each week, and all of a sudden you're the strongest man in the world. It's the combination of doing the little things right over a very long period of time and avoiding really stupid things.
Well, you didn't answer his question. Is it glutes or abs, man? You can't avoid the question.
Well, I'd say glutes, man. You can do more with your butt and your legs, running and jumping and all that, than your abs. Although core strength is important. Don't neglect it.
This is true. All right. So next question comes in from at Arco Capital. What up, Peter? He said, is there any correlation with the drop in your deadlift weight and interest rates and or underperformance of value indexes? I feel like I should re-ask that. I don't know if that was good English, but I think you get the point.
What's up, Peter? No, the drop in my deadlift is 100% explained by just becoming old. So, there's no other variable there. It's just old age getting the best of me.
Are we sure? And it has nothing to do with interest rates or underperformance of value indexes?
I would say those would be spurious correlations for sure, but Peter knows that.
Spurious, dude, that's way too big of a word for this podcast. Come on now. All right. So next came in from JD Banker at Dad Invest. What up, JD? He asked, where do you store your secret cigarette pack? And if so, what brand? This is actually very important because you can hide it in all sorts of places.
undisclosed location where the wife will never find them. It's my secret stash in the house, places that she'd never look. So she does a very good job of finding my old clothes and getting rid of those things that she doesn't like. So, without giving anything too much away. And of course, it'd be the Marlboro Reds for sure.
Of course, it'd be the Reds. Like we said, we're not 27s people here. We're Reds people. So, okay.
Exactly.
Now, this actually might be the most important question that was sent in. It was from Sean Tuffy at SM Tuffy. Is a hot dog a sandwich? I think we could go on forever. Is it?
To me, it's more like a bread wrap, because the bun is not really two separate pieces of bread. It's more like a taco shell type thing. So I'm going to have to say it's not a sandwich.
Okay, so then the follow-up logical one then is a hot dog a wrap and not a hot dog.
I think you've got a better case for that than calling it a sandwich. It's more like in its own little universe there, like a hybrid type thing.
So another follow-up question to that would be, is it by calling it a hot dog or a dog or a meat wrap, does it make it healthier?
Psychologically, yes, it makes it more palatable, say I'm not eating a piece of crap, I'm eating something that's healthy. And the fact that it's not fully encased and carbs, you're actually doing yourself a favor. So yeah, I'd say so.
All right, this is good. Don't worry, we only have 100 more of these, so bear with us, everybody. So Heyman 800 at Heyman 800 writes, by the way, love the Avatar Yankees logo, but that, your question, this shouldn't pertain to anybody that has a Yankees logo as their avatar. And they write in, why do girls point and laugh every time I try to lift weights at the gym? Sometimes it is what it is, right?
I do. Hey man, as a friend of mine, I have not been to the gym with him, so I can't speak to his specific experience, but in my own time and years past, it was always for doing something stupid. So, we'll have to figure out what exactly he's doing in the gym.
Look, I'm chalking this one up to the fact that they're pointing and laughing because they're sad at themselves for not being Yankees fans, because that should
well,
be.
What's he doing? Is he lifting weights in a Judge jersey or what? I mean, who does that?
Well, if you lift weights in a Judge jersey, you automatically, you gain an extra couple inches in your bicep.
That's probably fair. We'd have to figure out who would be the least desirable Yankees uniform to work out in.
That will be a great topic for the next podcast, and I think there's a few out there, that's for sure.
Yeah, they've had a few weak players over the years.
That's for sure. All right, so next up, John Bovey at Real John Bovey writes, what sector would you allocate completely to for the next 10 years, and why is it tobacco? This is more along the lines of an investing question.
Sure, he's a fellow tobacco investor, and I think if you're looking over the next 10 years, there's a strong case to be made that there are a lot of things to like about the industry. It's consolidated. There's a lot of pricing power. Recession resistant, as we've seen by stockpiling in this most recent crisis. And you look at the broader universe, it's not so much, from what do you have to choose? What's out there that's as compelling? And I always point out that as far back as the French data set goes to the 1920s, there's never been a negative 10-year period for the industry, at least domestically. So, I think, okay, well, a lot of people, when you have these kinds of questions, how would you allocate your money for the next 10 years? You think, how much money can I make? Well, I also think, what do you stand to lose? What could go wrong? And I think tobacco kind of gives you this sort of middle ground where, with cash flows and valuation, you have a chance to make a lot of money, but also because of the nature of the business, the fact that a lot of people don't want to own it. You stay away from excessive valuations. You have a little risk of a disappointing decade. So, and I've actually written about this before. You can find it on my blog, but, I always have to say tobacco would be my go-to if I had no other choice, and those are my reasons why.
Got it. And we'll get more into that a little bit later when we go through investing philosophy and strategy, because I definitely want to follow up and get some more knowledge. But we only have 2 more questions from Twitter. So we're
Gotcha.
Let's get through these. And then, so what next question is from David Taggart, pdmacro.com at David Taggart. He asks if a law was passed that said you can either deadlift or own tobacco stocks, but not both, which would you choose and why?
Definitely tobacco, because I've got a substitute good for deadlift. I can squat, so there's no real substitute for tobacco, but I can easily switch out, and you could argue too that squatting is more beneficial with less, potential for injury than deadlift. It's kind of a cop out, but, definitely I would part ways with the deadlift in favor of the squat and hold my tobacco.
Are you sure? Because I don't know if you get as much gains going to a squat than you do a deadlift. And that can be pretty important as we get up in age.
I think that's true. I mean, grip strength is highly correlated with, longevity and stuff like that. But, if in this binary dystopia where I can't have both deadlift and tobacco, I'm forced to choose. I got to go with my smokes.
There we go. All right. So final question, and thank you everybody again who sent these questions in. It's from AP18IPA Capital at 18IPA Capital. They write in, ask Lawrence why he has not locked down a new squat PR, I guess position or
personal record.
Personal record. Personal record. Yeah, what a noob. Okay. How come you have not locked down a new squat personal record during lockdown? I think we answered that, in that you really are focused on the deadlift versus the squat.
Well, the simple reality is, like a loser, I didn't invest in a home gym. So I was stuck doing cardio, man, the whole lockdown. You can even find it out on Twitter. My innovation was to run and then to push my Jeep around the parking lot at the building just to have something to do, because I didn't have any barbell, no dumbbells, and you couldn't find them anywhere. So, my simple excuse is I failed. I didn't plan ahead for, once in 100-year pandemic and have a home gym.
Oh man. Well, I think now, just in case there are future pandemics, now we know, now you know what you really have to prepare for, what's really most important.
Exactly. Forget stocking food and water. I got to get the squat rack set up.
That's for sure. Or just buy a ton of smokes so that our investments are okay for the foreseeable future.
Well, you know what? When currency becomes worthless, you can always barter cigarettes. So.
Or should we just tokenize cigarettes at this point? Because I mean, that can also be an ICO for tobacco. I think that has legs.
Like a cowboy coin type of thing.
Yeah, like a marble or a cowboy coin.
Well, I mean, at some point you could do that with your Marlboro rewards points or something like that.
That's how you cash it in to actually. Yeah, exactly.
It's probably the future.
Yeah. All right. Well, with that, thanks for answering some of these questions.
Sure.
That was so awesome. So, let's get into it a little bit. I'd love to get kind of your background. Really, where did your passion for investing and maybe even squatting and deadlifting come from?
Yeah, well, I started in the industry in the fall of 2002. I went to Rockhurst University, which is a local Jesuit university here in Kansas City, and had to figure out a way to pay for it. I was studying finance and economics, and after doing a few little odd office jobs, I caught on with a couple of financial planners, and they needed somebody to do modeling, spreadsheets, somebody who's a little more up to speed on forecasting and all these different things. And so, I just started doing that. And 3 years later, in 2005, I got my Series 7, all those different things, started managing other people's money, building portfolios, and some of it was by accident, some of it was by design. I mean, I was interested in investing as far back as high school. I had a really influential economics teacher, Mr. Shriver, if he's still out there listening by some chance. And I just thought, this is awesome. I got to talk to people about their future. We got to talk about industries, portfolios, all this stuff, and never look back. So, it's been an awesome 18 years or so in the industry, seeing it from the ground up, and being a financial advisor or managing pretty good sized portfolios, and having lived through a lot of different cycles.
Absolutely. I mean, what would you say then? From all that experience, what would you say then ended up being your investing philosophy and your strategy then?
I tend to be a little bit more conservative. The 2007, 2009 cycle was a pretty jarring event for somebody who had kind of come in at the tail end of the dot-com bust, which, in retrospect was really kind of a tale of two markets. That was really more about tech and telecom getting destroyed versus, most other industries. 2000, 2007, 2009 was everything getting annihilated, and, really caught us off guard in terms of our positioning going in. And it really kind of gave me the sense that, especially managing retirement money, you got to appreciate the potential downside as much as looking ahead to see what kind of returns you can get. And so that's why I've kind of defaulted towards more conservative portfolios, gotten away from a lot of cyclical industries like banks and so forth that don't necessarily control their own destiny, in my opinion, with interest rates and things like that. So, I guess in a word, my philosophy is like a doctor, first do no harm. What if you manage risks, the returns will take care of themselves, so to speak.
Got it. So let's say when you're evaluating potential new investment, what's some of the criteria that you look at in order to manage some of those risks?
Well, obviously you start off with the individual's goals and means and what that person is willing to stomach, what that person's willing to own, immediate cash flow needs, some of those basic things. And then we walk them through our process and say, is this going to be a fit for you? Understanding that it's going to be kind of a different experience in most cases from being somebody who puts money aside for retirement. Now you're having to draw on that. It's going to be a different animal as far as relying on your portfolio for income. And this is what you can expect. And it's not a fit for everybody, but as an advisor, the client's not just interviewing you, you're interviewing the client, to say, is this going to be a good long-term mutually beneficial relationship? And that's something that, as my business partner Dennis likes to say, there's some things that you can learn and other things that you can be taught. And one thing you definitely have to learn is that some people, despite what you might think, they're not going to be necessarily great clients because they, everybody has different business models and they don't always fit yours.
Absolutely. I mean, you talked about, earlier in all of our questions, how you kind of made a name for yourself in some of the research that you put out there on tobacco stocks. Can you explain what that thesis was and or is currently? And then I'm probably gonna have some follow-ups from there.
Sure. Yeah. As far as tobacco stocks go, the things that I like about it, I pointed out in a tweet earlier this week. You can search the feed. It's kind of like with the industry, we know it's a melting ice cube. The number of smokers is declining in the U.S. For sure. It's declining a little bit less slowly overseas and emerging markets in Europe and so forth. But we know because of the regulations involved, it's become a very consolidated industry with a lot of pricing power. And arguably, a lot of that is related to the regulations involved. It's very difficult to become a new tobacco company with, for example, the FDA rules for getting your products approved and all these sorts of things. And you can kind of look at the market share over time. They've been very consistent for the major players. And I think when you look at that, you look at human nature, it's obviously an addictive product. They have diversified product lines with oral, combustible, and now some other things. And there is an appeal for nicotine consumption around the world. Now, the nature of how nicotine is consumed is changing a little bit, but it's going to be here for forever, probably. And I would rather play in an industry where market share is pretty consistent, pricing power is great. What other industry besides tobacco can you consistently raise prices above the rate of inflation? I can't think of any. And you look historically, as I mentioned before, there's never been a negative 10-year period as far as I can tell. Looking at history, it's been through all sorts of cycles, valuations, because a lot of people don't want to own the stock. valuations are very rarely excessive, maybe not ever. I don't think they've ever really exceeded, the low 20s as far as multiples go. And one thing that makes a good industry is not just the fundamentals of it. It's also the fact that it's never going to get overvalued to the point where your future returns are diminished. And so, that's why I think it's very hard to come up with industries with so many positives, for lack of a better word.
No, right. Absolutely. I mean, what, I'm sure you get this question all the time. I'm sure you get it. It's probably annoying to you at this point, but I have to ask, I mean, do people, when they say about, when it comes to tobacco and addiction qualities to it, and just all the negative aspects of tobacco, what do you say to those who have that thought process, and yet, because it's not so much, it sounds like you're supporting the industry itself. You're not a smoker. It's just a matter of, look, I'm just looking objectively at the industry as a stock, right? I mean,
Right. No, I think that's an important question. And obviously our clients, we just present the argument for it, and they can choose to have it in their portfolios or not. And some people choose not to, and that's perfectly fine. My argument is, where do you draw the line? So if you own shares of Walmart or some other retailer that sells it, or any other affiliated type industry, you're going to have some exposure to it regardless. And so it really doesn't make a lot of sense in my mind, buying shares on the secondary market, how that is necessarily supporting the company. You're not literally giving money to the company. In other words, they're also giving you money, which you could theoretically use against them if you're opposed to their industry. I mean, there's a lot of different ways to sort of rationalize it, but really, it just boils down to the fact that if your overall goal is to fund your retirement, accomplish your portfolio objectives, this is an industry that has a lot of positive things about it if you can kind of get over the visceral reaction to the product and the downsides of the habit. But people should make an informed decision, and if they choose not to, that's perfectly fine with us. We'll figure out another way to make it work.
Absolutely. So shifting gears a little bit, we are, we're in a pandemic. It's been, suffice it to say, an interesting few months, so I'd love to get your take on everything that we've seen, everything that's gone down, other than, not other than, just everything that's gone down, really.
Yeah, well, I think we came into the, let's take a step back and we look at where the market has been, because that's our focus really. And 2018 was kind of a year of multiple compression, coming off a big year. And 2017, the Fed was raising rates. We saw that big decline in December. And then 2019 was kind of the reflation trade. Multiples expanded, the Fed eased up a little bit. And so we came into 2020 with a pretty fully valued market, in my opinion. And I expected probably flat to slightly negative, slightly positive returns, just because I thought some of that valuation, that excess return or expansion, I should say, in 2019 had to be worked off. I didn't have a pandemic and a huge crash as part of that thesis, but here we are. It is a sort of bizarre set of circumstances. You have to ask yourself as an investor, how much of what we saw in late February and March related to the virus itself, and then the associated economic lockdowns. My personal feeling is that you would have seen at least one quarter of pretty negative growth, regardless of the lockdowns. It's not clear what's going to happen, as we kind of go through the summer and you see some case counts rising. It's going to be a varied experience across the country, I think. Certain areas of the country are going to be more affected than others. So it's going to be kind of a sort of a treacherous path to walk over the next few months. You can debate, whether or not we'll get a vaccine. It may not even matter, at the pace that this thing might be spreading. But, it seems to me that we've just had gargantuan natural disaster of, almost incomprehensible size as far as, the economic magnitude, job losses, lost economic output. But, I think so far, so good as far as the economic data are concerned, as far as a rebound might go, and whether or not it can be sustained. All eyes are going to be focused on jobless claims and unemployment numbers. And, July is going to be a big month when some of the um, unemployment benefits kind of roll off, the enhanced benefits. So it's going to be an interesting summer, that's for sure.
Oh, for sure. I mean, how would you say your principles, your investing principles or strategy has changed at all or altered as a result of the pandemic? And, just holistically, has it changed? Or is it more like on a case by case basis when you're dealing with various portfolios?
Yeah, I mean, it's definitely on a client by client basis, but overall, I would say we were much better prepared for this than 2007, 2008. We have um, kind of a tilt towards quality and min vol in a lot of different cases. We didn't have a lot of cyclical exposure in most cases, and so I think that's until we kind of get a clearer sense of where the economy is heading. We're just kind of staying pat. But one thing that does interest me as far as where we go from here, and something that I haven't quite wrapped my head around, is what are the next 10 years going to look like? And are they going to look anything like the last 10 years? We haven't had inflation for a while. We've got a lot of money floating around the system. We have depressed commodity prices. We know how poorly energy stocks have done. And I'm starting to think, okay, well, we might be well positioned for the next few months, but what about the next decade? What am I missing here? And it's just hard to think because you look around the world with negative interest rates. Japan famously has huge debt to GDP ratios, and said they still struggle with deflation. So it's just it's kind of evading your question, but I'm just thinking, okay, I think we're good for the next couple of months, but I don't know if we're going to be good for the next decade because there's a lot of things that could change in a pretty quick order too.
Well, let's spitball. I'm not going to let you evade that question. We're going to do a therapy. We're going to do a financial therapy session right now. All right. So, 10 years. Okay. Let's go through what's been internally going on. You alluded to a couple of things. I mean, what else could there be? I mean, we know there's going to be a lot more technological innovation. We know there could potentially be some changes in terms of commercial real estate where people are going to be starting to work from home. It's just trying to really look at all the potential trends that could be happening. I mean, what are some of the other ones that you've been kind of spitballing?
I like to think that the future is not going to look too different from the past, but I say that in broad terms. Human behavior may not change as far as consumption, and I do think, for example, that fossil fuels are still have a large role to play in our economy. It's sort of hard to wean yourself off of them when they're so cheap like they are now. Even with electric vehicles, I think industry is still highly dependent on fossil fuel consumption for their purposes. So, I think in some ways, bigger trends will still be in place, but I think you will see, at least in the near term, a lot of pain in commercial real estate. A lot of people are going to be reluctant to go back and work in big offices, and you have second order effects on things like office supply companies and cleaning companies, because suddenly they're not necessarily needed. On the other hand, trash collection companies might benefit because, they can charge their customers because they're picking up more trash than they otherwise would be. There's little things like that I think might be interesting trends to come out of all of this. Certainly, what interests me as a thesis is more private car ownership and less public transit use. people moving to the suburbs, having to, buy homes and outfit them. That seems to be something that is uh, a sustainable trend coming from all this. Again, it'll affect different regions and different orders of magnitude. But, as far as will people ever go back to their offices, I think they will, but maybe not as much as they were in the past, and certainly not right away. The real estate industry is going to be a little bit different. Which there's certain sectors of real estate, for example, that should do just fine, and others that'll be hurt. I would argue maybe self-storage or data towers, things like that. They're probably not going to look too different, but and then we haven't even talked about any healthcare facilities. We know what a role that's played in the pandemic, and how are those going to change, with costs and all the the misery that we saw in nursing homes. So those are, I guess, to answer your question, I might have opinions on those areas, but I'm not willing to. I think, as somebody once said, it's easier to identify the losers from a regime change and something like this than to identify the winners. And with that in mind, I think, there's just some places that I wouldn't be comfortable investing for the long run, but would I bet against them? I don't know. I'm just sort of agnostic, if that makes sense.
100% makes sense. I mean, it's interesting because it kind of fits what your philosophy is, this, really more of a conservative approach. I mean, so for you, I mean, with that in mind, what tend to be, especially in times like these, what you want to focus on in your portfolio?
Sure, exactly. Yeah, I think it's just, the whole point is kind of like, if you, especially with my client base, is mostly retired folks, just erring on the side of caution. They'll forgive you for missing home runs. It's a little less easy to forgive, 5 or 6 strikeouts in a row. And of course, there's a lot more downside than, just a swing and a miss, so to speak, in this business.
Does that, I feel like for you, with that strategy in mind, it almost makes you sleep better at night. Cause like, okay, I don't have to be one of those firms that's, always showing, a crazy win percentage every year. I know that my client base is happy with singles, doubles, even if we just kept it and saying, I'm totally cool with being the Ichiro of RIAs right now.
Yeah. And I think that there's this, in the long run, people gravitate towards those who fit their styles, or the people that they're going to work the best with, if that makes sense. And so in many ways, I'm a reflection of my investor base, and they are a reflection of my philosophy. And many of them I've worked with for at least a decade, and in some cases longer than that, close to 15 years or more. And so it's just like, they know, they've been through now 2 pretty big down cycles and a lot of noise in between. And it is, in the end, a performance-driven relationship. I mean, they understand what we're getting paid to do, and they are going to hold us accountable. But they're also, in my opinion, more appreciative of, not taking a lot of risks, so to speak, and making sure that they're hitting their goals with, a commensurate amount of risk or volatility than, saying, try to, bat for the fences, and, you'll fall on your face 9 times out of 10. That's not going to be a good relationship for us. They know that.
For sure. So then my favorite question to ask everybody that I have on here, to you, Lawrence, what investing experience would you say has impacted you the most in your career?
Without a doubt, it was the experience owning some bank stocks in 2007, 2009. This was something that, these centuries old institutions like Lehman Brothers, Goldman Sachs, Washington Mutual, all these different things that we know that were just brought to their knees. And just watching them, didn't necessarily have positions in all those, but just watching them get, just devastated by this, kind of black swan type event. It just kind of led me to think, okay, well, maybe I don't have to own all parts of the market. Maybe it's okay just to participate in those areas where I think I have the most, the most fundamental support without taking a huge ton of risk as far as the possibility for another black swan event to just devastate their business models. And so that really sort of keyed my interest in looking at, any potential holes in portfolios that, should something like that happen again, you just wouldn't wake up one day and find out that, you held a bunch of worthless equity. And whether or not that's unfair to bank stocks I don't know. It just kind of led me to believe that unless you're an indexer or you just kind of are completely passive, um, you know, maybe you need to have a much better understanding that when you invest in these companies, there's a lot of potential, and it's not evenly spread across all industries, right? Some have much bigger implicit risks than others, and the data show that as reflected in volatility and drawdowns and so forth. And so it just sort of made me appreciative when talking with clients and building portfolios that there will be cycles when some of these things that were underweight in portfolios that they'll be doing better, but there's a reason why we decided to be a little less exposed in those areas.
Got it. So would you say at that time, you were more focused on the fundamentals versus understanding the industry as best as you possibly could? Was that part of it, or was it more just, hey, all right, I see these are good fundamentals. It's a bank. What could possibly happen? I mean, were
Right,
some of
right.
that going through your mind?
Yeah. No, it's just like, okay, well, we know that it's obviously a very cyclical industry. We know how they make money, um, you know, borrowing and lending out and so forth. And I just think, okay, well, what happens when the tide goes out? And it's not really an industry that's unless they have alternate methods of earning profits. It's kind of hard for them to make money in all but very favorable macro environments. And so, and plus you have the embedded leverage and all these different factors. And so it's just something that I thought, okay, well, I'm going to try to focus my portfolios on those industries that I know have um, sort of a secular tailwind as far as growth goes, and they're not going to be subject to, you know, needing to have a robust macro backdrop to do well. And, never mind the fact that you have, kind of a heavy regulatory burden. So there's a lot of different factors, but, that whole experience in 2007, 2009 really forced me to rethink a lot of things and just try to look beyond just the fundamentals of each company and the industry itself and think, okay, well, what outside the industry, what external forces could come and really cause that to, be a disaster?
Absolutely. So my next question is actually a really important question because, we've been seeing a lot of some of what's been happening in the markets as a result of a lot of new retail investors, opening up Robinhood accounts or Charles Schwab accounts, just all new accounts to get in on the action, so to speak,
Mm-hmm.
and we've seen some people have done well and okay, and then we've also seen some really devastating things. I invite everybody to go listen to Tobias Carlisle's recent episode, Value After Hours, with Jake Taylor and Bill Brewster, where Bill was sharing his family tragedy that happened, and I think it's really important to bring a spotlight to that. So I ask you, Lawrence, for some of these new investors that are very new to the stock market and trading and just playing with all this crazy volatility that's out there, what advice do you have for them?
My advice, first of all, is to make sure that you get a lot of opinions, before doing anything. Talk to a professional. If you don't have one that you trust, as maybe a family member or something like that, get as many opinions as you need before you start to do anything that, it's obviously just like with a car repair or home repair, or anything else, you're going to solicit a bunch of opinions. Investing is obviously, the potential downside is immense, when you're talking about your meager savings and things like that. So, the first thing is find somebody that you trust, get a lot of advice before you do anything, make sure you know what you're doing. But obviously before you start to get into the trading and the investments, have a plan. Understand that it's a long-term thing. It's not gambling. It's a completely different animal. You're going to have a hard time understanding your real exposure if you don't understand the nature of options trading and how that works, and how that the way that these things settle out in your accounts. It's just, you can never get enough advice. Now, the second part is knowing which advice to take and how to act on that. And that's not always so easy to identify. But, maybe the best thing to do is to move at a very slow pace. And, like I said, first of all, have a plan, just do things gradually. Don't jump in, and try to gain a little bit of experience as you go, and learn as you go. I mean, having a little hiccup every now and again is inevitable in anybody's investment experience, being human, and people make mistakes. But yeah, just getting a lot of input, a lot of advice, trying to read as much as you can. There's a ton of resources out there. A lot of it's free. You got all the time in the world. Don't be in a rush. Just, it's again, it goes back to the first thing that one of the first things I said, which is, have an eye on the potential rewards, but also keep in mind the downside. There's a lot of risk there.
I was going to say my main takeaway from our interview today is you can make money with a conservative approach. You don't have to be the day trader and going through all. I mean, that can work for you if you do the work and you understand what you're doing and you have a plan. But if that's not your personality and that's not the type of investor you will be, you can make money with that conservative approach.
There's a reason why. If you look at the data, there's plenty of data to support this. You can go look out on our website. There's plenty of blogs about this. Pim Van Fleet, Paradox Investor on Twitter, he's written a lot about this. There's a reason why stocks with a lower degree of volatility historically have outperformed. It's a human nature type thing. People like to try to get rich quick. It's kind of like the Staples easy button. They want to make up for lost savings, or, do whatever to try to hit that lottery type stock. And in reality, you end up ignoring a lot of the high quality stuff that's, going to compound over time. And the valuations usually are much less. And we know that, it's a lot easier to lose money than to make money.
Absolutely. I mean, look, at the end of the day, these trading platforms need to be accountable for the fact that there are new investors coming onto their platforms and starting to trade stocks, whether as a day trader or as an investor. And I think we can all agree they need to do a better job with education and making sure that their platforms are very clear for anybody that's going on there and, trading options or any of these, fancier instruments out there.
Yeah, I think that's true. And, there's that balance, between caveat investor and what their obligations are. And unfortunately, you can only look out for yourself, right? And we owe it to ourselves to educate ourselves and to tap all the resources that we have available, and really be guarded with how you interact with your money. And it's hard to earn, it's easy to lose. Just, I think caution is the byword there,
especially in these times. So with that, where can my audience go and find everything they need to know about Lawrence Hamtil and your blog?
Well, you can go out to our website, which is just fortunefinancialadvisors.com. There's a little tab for the blog. I don't write as much as I used to, but try to do once, every couple of months, take a few deeper dives than in the past. A lot of research projects there. Happy to respond to any emails or questions if somebody writes me. Twitter is just Hamtil, LHAMTIL. Messages there are open, so if people have questions, want to reach out, I'm available. Try to get back to everybody. So that's basically it. Those are the only real platforms that I have. I'm a pretty boring guy, so.
I mean, how can you be boring when you're so focused on your deadlifting, squatting, the tobacco? I mean, there's a lot going on with you. You're a lot more complicated and interesting than you give yourself credit for.
Yeah, it's definitely a different take from most of what you'll see on Twitter, but whether or not it's nonsense, I'll leave somebody else to judge that.
Well, I highly encourage everybody who's listening, please ask him as many questions as you possibly can about deadlifting and squatting and anything you want, of course. But Lawrence, thank you again, man. I really do appreciate you taking the time to do this. And I look forward to our next chat. This was a lot of fun.
Thanks. I appreciate it. It was a lot of fun.